Hi, everyone. Welcome to the first ever Facts versus Feelings, Take 5 with Ryan and Sonu. Sonu, we've got 5 minutes to discuss some big things that are taking place. The Fed did not hike interest rates after 10 consecutive hikes going over the last year plus. What's your take? Is the Fed done, Sonu? What did they just say last week?
There were so many things going on with that Fed meeting last week. Did they pause or did they skip? Was it dovish, hawkish? They paused rates as expected.
Mm-hmm.
Big story was how they raised their own expectation for interest rates in 2023 to end up at 5.6%. It was 5.1% the last time they made that projection. That was seen as really hawkish. But what didn't kind of make sense is, wait a minute, if you're going to raise your projections up by 0.5%, right? You're obviously worried about inflation and all of that. Why not just raise rates now? Why pause, right? So I think there was a disconnect immediately. And I think what happened was the Fed officials are trying to instead to signal to markets that don't expect us to cut rates anytime soon, right? The good news was there were some other projections that, made sense by itself, but within the context of them raising their own projections by 0.5% didn't really make sense. They raised GDP growth expectations for 2023 from 0.4% to 1%, right? 0.4% means they were expecting maybe a recession, but at least a sharp economic slowdown. They've taken that to 1%. They're no longer expecting an economic slowdown. That's a great sign. They're basically acknowledging that, you know what, we've raised rates from 0 to 5%. The economy is still strong. The economy is resilient, and we're going to take it, right? We believe in, they didn't say it in so many words, but effectively conveyed the fact that, we think we could achieve a soft landing here, right?
And that's a lot different, obviously, than what even the Fed was saying. A lot of people have been saying. But the bottom line, again, the economy is still strong. The Fed could be done. Just think about this. If the Fed is done hiking, if you look at the last 10 cycles, everyone, 1 year later, the S&P was higher, 8 of them. So once the Fed stops, stocks can continue to go higher. So when they have to start cutting, when you need to worry, we don't think we're close to cutting. So the other part of this, inflation. I mean, the Fed, if inflation was still running hot like it was a year ago, they would be hiking still. Inflation, whether it be CPI, the consumer level, or PPI, the producer level, inflation's coming back. And even inflation expectations, what the consumer expects inflation to do, has been coming back significantly. I mean, in 30, 45 seconds or so, round up for me what you're seeing on the inflation front.
So we have two pieces of inflation, right? One is headline inflation. That's everything together, right? Headline inflation was 9%, above 9% last June. Right now, it's down to 4%. Why?
Yeah.
Because energy prices have fallen a lot, right? But even food prices and vehicle prices are going down, right? So that's why headline inflation's down. Now, the rest of it is what the Fed focuses on, because they think that's core inflation, right? And that's still running around 4.5%, 5%. It's still too hot, and that's why they don't want to take their foot off the pedal. But the good news is a big part of that is housing or shelter inflation, right? And shelter inflation, as the Bureau of Labor Statistics measures it, is using rents. Now, official rental data lags private sector rental data by about 12 to 18 months. Private sector rental data has, it was running at a peak pace of 18% about 18 months back. Right. Now it's down to 1%. We didn't see that deceleration in official data until like 2-3 months ago. And now I think we can safely say that's turning lower. And that means core inflation is going to head lower. That's good news for the Fed.
Oh, absolutely. Again, it gives the Fed leeway to stop hiking rates specifically. We also just last week saw retail sales come in. Again, just real quickly, better than expected. The consumer continues to be this strong part of the U.S. Economy that continues to surprise the upside. We've seen manufacturing likely bottoming. We've seen housing likely bottoming. We are in the it was lonely at the start of the year. Now it's not so lonely. The bandwagon's get a little full, but the idea that we're not going to see a recession this year is remains strong. We've got about 30 seconds, so I'll just jump in and point out a couple positives. S&P's up about 15% for the year. Just made a new 52-week high last week. When I look back in history, when you go more than a year without making a 52-week high, 1 year later, S&P's been higher 15 out of 15 times, up over 17% on average. We just started a new bull market, which is up 20% from the October lows. 1 year later, when you start a new bull market, higher 12 out of 13 times, up about 17% on average again. So everyone, we've had a great run. The Fed is likely done hiking. Inflation's coming back. the idea that just because we're making new highs, breaking out the new highs or 52-week highs, that doesn't mean this rally has to end. In fact, we still think it can continue. And with that, we've hit the 5-minute mark of Facts versus Feelings Take 5 with Ryan and Sonu. This was a lot of fun. We'll see everyone next week. Take care.